Hello, welcome to our 2025 mid-year investment market review and outlook. I'm Ben Hockema, founder, advisor, chief investment officer at Illuminate Wealth Management, and we are here to talk about the performance of the markets around the world, both in U.S. and international, talking about gold and bonds and everything in between. And we're going to jump right in to several slides that we have, just so that everyone knows. A lot of the data that I'm going to show is as of the close on July 25th. I just wanted to make sure that you know what dates we're using for it. Otherwise, it's going to be 6:30, and we'll talk about that as we get there. So as we jump right in, we want to talk about performance year to date. We're going to kind of hone in a little bit on U.S. stock valuations as we look ahead, also look at bond opportunities, and then talk about a few predictions for rest of the year, just to have a general sense of where we see things going as we look ahead. So if we jump into year-to-date performance, I'll quickly walk through what this is showing you and what this tells me and where we are. So number one, going down the list, and I'm going to actually use the one to the top. So we've got the Spider S&P 500 ETF. That is the S&P 500 large cap U.S. stocks. Then in uh, peach color, we have the Invesco QQQ Trust. That's NASDAQ stocks. That's more tech stocks. Then in the blue, really worst performer for the year is the Russell 2000. That is small cap US stocks. In the light green, we have developed international stocks. So that's countries like Europe, primarily Western Europe, Canada, Japan, Australia. Those are all big numbers, big players there in the internet developed international stocks. Then we have emerging market stocks in the fuchsia color. That is China, India, some Eastern Europe is in there, South America, all a part of the emerging market stocks. Then we have bond markets, the total bond market index. That's mostly U.S. Treasuries, or a little over half U.S. Treasuries, and then corporate bonds and everything in the U.S. on there. And then we have the best performer for the year, up almost 27%, is gold so far this year. So as we are looking at this chart, there's a couple things that jump out to me. So obviously, if we think back a couple months ago, back in March and April, we had a big fall off in the market. Most things were down. Basically, everything was down except for bonds and gold at that point. If you look at that April time period. And then since then, we've had a nice recovery coming back up. Last time I recorded a video and we sent it out was on March 14th. And I said something at that time. So you've already started to see things fall a little bit. Most indices were down for the year at that point. What I said at the time, and yes, I'm patting myself on the back, was that I would expect to see new all-time highs in the S&P 500 before the end of the year. Didn't know when that was going to happen. Well, we did that in basically 3 months later at the end of June. So before the second quarter ended, S&P 500 had hit an all-time high and has continued to move higher as you look ahead. And so there's been some resiliency. A lot of that had to do with the initial tariff scare and then new negotiations and things. But over time, we expect markets to go up, and we expect that 75% of the time stocks are up and 25% that they're down. And if you just do that over decades, you're going to make a whole lot of money. So one thing I want to really point out as we move forward is here on this chart, the 2020 to 2025. So what I did is I went back to January 1st, 2020, and said, what would happen if you invested $10,000 into each of these various investments that you could put money in? And you can see that the best performer, $10,000 invested January 1st, 2020, kept it in the market, held it that entire time, move up. That's NASDAQ. You would earn the 10,000 would turn into 27,500 at that point through the end of the day on July 25th. Behind, so obviously not nearly as good as 27,000 from 10,000, but still more than double, is both gold and the S&P 500, both right around the 21,000 mark. And then you can see all the way at the bottom, we have bonds. Bonds, you would have earned $200 over 5.5 years by owning bonds. That includes both income and price change. for all of these, this includes dividends or income and the change in price, you would only have 10,200. So a couple things jump out to me when I look at this. Number one, invest for the long haul. If you look at this chart, there are three distinct bear markets that are in here. So I've heard a lot of clients and a lot of the investment media talk about, oh, this is too good to be true. The markets just keep going up, and basically since the great financial crisis, everything's gone up. Looking at this chart over 5.5 years, you have three times that the market was down over 20% off its high. Three different times. You've got 2020, you've got 2022, and then you've got earlier this year, 2025. That is very volatile and very difficult to stick with it. And so investors who've been able to stick with it have earned the right to earn this money, because you've weathered through the ups and the downs through investments. And so just because the market is up in aggregate over that time, let's not be blind to the path to get here and the fact that it is very volatile across the board for every type of investment. Um, but I also want to point out on the other side is bonds. Bonds have done absolutely nothing for 5.5 years. Now, they started off, made a little bit of money, and then they dropped in 2022, really when interest rates started to go up. So if we step back to kind of bond math, when interest rates go up, the price of bonds drops. And that is been the problem as we look at bonds over this time period is interest rates have gone up, and so the bond prices have dropped, and you haven't made up the returns with higher interest yet. So the income's not been produced. Bonds have an important part of the portfolio. It's to produce some income so you can earn interest. And it's also to protect on the downside. So during those three bear markets, two of the three, bonds did a great job. Earlier this year, bonds held up for the most part. And in 2020, they were steady as everything else was down 30%. The problem is in 2022, stocks and bonds moved in tandem and both were down double digits. It was the worst year for a diversified portfolio over the last 100 years if you had both stocks and bonds. So, what does that mean going forward? It means we have to be very intentional about how much you have in each of these different investments, but we also don't want to be scared in the stock market just because in total we're up. We expect you to make money over time. So bonds have a place, stocks have a place, and it's our job to make sure that you've got the right allocation between the two. I'm going to shift gears a little bit, and I want to talk about a little bit more. The data on this next chart is through 6:30, so through the second quarter, but I think it's giving you a good glimpse of the first half. So what we're looking at here is what's the performance in the first half of the year for S&P 500 in the dark blue, let's focus on the top chart first. S&P 500, so U.S. stocks versus basically developed international stocks. So we're just comparing U.S. versus international for the first half of each of these years, going back to 2006. And so you can see that right now is one of the most pronounced times that international stocks have outperformed U.S. stocks. And the difference, just so that you know, is 19.4% for developed international so far this year versus 6.1 in the U.S. So that is some of the biggest difference ever that we've ever seen of comparing the two. And that is driven really by two factors. And so that's what the purpose of the bottom chart is. So let's just focus in on the developed international, the EFE chart that we have here. And looking at the two different colors. So again, bottom chart, we have priced in US dollars versus local dollars. So if we just compare 7.8% versus 6.1%, what that's telling you is if you invested and the dollar did not change in value compared to the euro, for instance, then if we just look company to company, we would expect international stocks were up 7.8% versus 6.1. So the performance of international stocks, they've made more money in local currency than the US. But because we are investing in those local currency and then converting it back to US dollars, when you see the returns, though that 7.8% gets added to by the fact that the euro is worth more now than the dollar or other currencies, the dollar has gone down about 11% so far this year. And so that has led to additional performance for all international stocks. So the takeaway here is twofold. One, the US dollar depreciating has absolutely helped our international investments. You can see on that bottom chart across the board, there's a pretty big impact by the change in currency. But at the same time, that's not the only reason that international stocks have outperformed. They've actually outperformed if we hold currency constant. And I think that is very important as we look ahead to how are we going to invest. Um, International stocks coming into the year were some of the most undervalued they've ever been compared to U.S. stocks. You take two companies, same sector, same earnings, and you would pay significantly more for it being headquartered in the U.S. versus internationally. And so that price difference creates an opportunity where you can have outperformance on the lower value because you buy low, sell high. So we want to buy what's relatively low and theoretically sell what's high. And so you've already kind of seen that companies have made more money, and we don't bet on the currency. We watch the U.S. dollar and how that changes. If you've seen my previous videos, we talk about it almost every time because that is a big impact in the returns across all markets. But the international companies are actually outperforming U.S. companies on a currency neutral basis, and that is, I think, promising as we look ahead to continue to see that happening. Another way to look at this is actually looking at U.S. valuations as we are now. So if we go back in March, like I said, markets were down early April, and we didn't panic. If we had cash available, we bought some more stocks at that point. Excuse me, and we have let it go up. But now that we're looking here, so we're sitting here in July, end of July 25, we have to make decisions on how do we invest going forward. And we need to go into our view of US stocks, keeping in mind that we are at full valuations. And what we mean by that is what we mean by valuation is what price are you paying? What price is the market paying for the earnings, the profits of the companies that you're buying into. So that's called the price earnings ratio. So if we look ahead, the forward PE, price earnings ratio, that's just basically how expensive is the market. So the higher the number, the more people are willing to pay for what we expect the profits to be. And this is an important factor. And really, if you just know, basic fractional equations. You have price divided by earnings, multiply that by earnings per share, and you get the price per share. So the two factors that matter are price earnings ratio and earnings per share. And so we've got this grid here that we can see, okay, what if different scenarios happen? So for this initial discussion, let's ignore the bottom and the far left, the recession average and the average recession numbers. We don't want to talk about recessions. I prefer to avoid recessions. Let's not dwell on that. But if we look at the zero, just honing in on the zero, we've got current. So the current PE is 22.2. So take an earnings of a company, multiply it by 22.2, and that's how you get the price. And if earnings per share continue where they are the rest of the year and the PE doesn't change, you get no performance. You get no price change because earnings didn't change and the price earnings ratio didn't change. Let's say that earnings come in better than where we are right now. So the consensus estimate that most analysts have is that through the end of the year, we're going to see 5.8% additional earnings. So moving across the top as we have at the x-axis. And so consensus is 5.8. So if you maintain the forward PE of 22.2, the current level, and earnings go up by 5.8%, then you're basically 6%. You're going to earn 6% for the rest of the year if earnings come in higher and everyone's willing to pay the same valuation for those earnings. If we get to a 10-year average on the far right, the average 10-year earnings per share growth of 8.5%, that suggests that we're going to see a 9% growth if you just keep valuations the same. However, valuations, as I said, are high. So we're at the 22.2. Let's just step down and say, let's look at the last 10 years. So if we return to valuations to the 10-year average of what people have been willing to pay over the last decade, you would fall down to 19.9 is the PE. So let's just do the math. So if earnings are where they are right now, so the current column, but they drop the price earnings ratio, the forward PE, the valuation down to 19.9, that means, just using math here, that we are going to see a 10% drop in the US stock market. So current earnings, PE down to the 10-year average. I think a realistic spot to go is to actually look at the consensus earnings per share, so 5.8%, but still drop down to your 10-year average. So that would um, still have losses. You would lose 5% in that case. Wouldn't be horrible, but it would make things a little bit more fair valued, not overpriced, but you still have earnings growth. And then if we have the 10-year average earnings growth and 10-year average PE, we still have a 2% drop. So I would say it's basically even at this point if we end at the 10-year and the 10-year. But if you look at all these different numbers, you got the 20-year, we've got recessions, we have the 20-year peak. What this was kind of says, and let's just go all the way to the best case scenario. The only way that we earn 15, 16% from here is if valuations go up and earnings per share increase. They both have to happen, or we're not going to get a double digit return from here on over the rest of this year. And so as I look at this chart, a couple things jump out to me. So number one, we are higher than average price earnings ratio, higher than 10-year, higher than 20-year, much higher forward PE. That doesn't have to come down. Unfortunately, that creates a scenario, though, where there's more downside than upside. So we have the ability to make more money in stocks over the next 6 months or 12 months by having earnings growth, and that's going to be the biggest driver, and maintaining the current valuations. But if one of those two doesn't happen, if we have a drop in PE and or a drop in earnings or just not a growth in earnings, you're going to see a scenario where you don't really earn a lot in US stocks. So, what that means for your portfolio is we are looking to rebalance. We've already been underweight US stocks for this year compared to the market. So, all of our investors have more in international stocks than they would if they just held a market portfolio. If they just bought every stock that's out there for what it's worth, you own more international stocks, so that's helped so far. And we're going to maintain that underweight of US, the overweight of international. And because things have recovered, we have some gains that we could take on the margins and just be very careful as we're investing here. So let's not count on a huge increase in the US stock market the rest of the year, given earnings have to go up and valuations have to go up for or maintain at least at the same level for you to get those earnings. Now I want to shift to bonds. So we're going to talk about how attractive fixed income or bonds are right now. So what you're looking at here is looking over the last 20 years, and each of these dots are different segments of the yield curve. So cash and then short-term bonds, long-term, the aggregate bond market, investment-grade corporate bond, high-yield corporate bond, municipal bonds, TIPS bonds. All of these are saying what percent is the current rate versus the last 20 years. So the higher the number, the more attractive it is now compared to the last 20 years. So cash is paying more today than 82% of the time in the last 20 years. So that's good. We like that when we're looking to invest into bonds. Short term, long term, ag, all of these are pretty attractive compared to the last 20 years. And that makes a lot of sense because interest rates have started to go back up. They were low for a long time post the great financial crisis. And then they went up there in 2022. That's why you had the negative performance. Well, now is a great time to invest, and it's kind of across the board, except for one specific area that I want to point to, which is well, actually two. So on the far right, we have investment grade spread. So investment grade corporate bonds are really not paying much more than other aggregate bonds that you could buy. So it doesn't make a lot of sense to take risk in your portfolio and the types of bonds that you have. You're not getting paid for that risk. It's only 2%. It's about the most expensive it's ever been. And then also high yield. So high yield bonds are compared to the aggregate, um, high yield bonds are paying very little. You're not getting compensated for the additional risk. High yield, another name for that is junk bonds. We don't want to buy junk bonds. We don't want to buy high yield bonds. And we got to be careful as we're looking at investment grade corporate bonds on what they're paying. And so it makes sense to have a little bit more treasuries, have a little bit more in TIPS bonds, have a little bit more in municipal bonds, things that are on the lower end of the risk scale, but are relatively attractive. So all this to say, as a whole, I would say that fixed income bonds are more attractive today than they have been in some time, and you're going to see that as we go throughout the rest of this year, buying some more bonds and putting things in the portfolio. Another factor of what makes fixed income interesting is the potential return as rates move. And so when, as I said before, when interest rates move, the price of bonds changes in the opposite direction. So if rates go up, price of bonds drop. That was 2022. Today, if we look ahead, we expect anywhere between 1 and 3, so let's say 2 times that the Fed's going to cut rates this year. That means cut interest rates on the short end, lowering that rate, and then we would expect bond prices to go up. So you're going to get some performance. So let's just focus on that section there in the middle, the Bloomberg US Ag. So that's just the aggregate bond market. And let me walk through what this looks like. So if interest rates go up 1%, so 100 basis points is 1%. If you go up 1%, we would expect bonds to drop 1.6%. However, if interest rates were to fall by 1%, we would expect existing bonds to earn 10.6%. And if you just held those to maturity, the yield to worst is 4.5%. So when we look at this just right there, unlike stocks where the skewness on the potential returns is on the downside, everything across the board on here suggests that no matter what happens to interest rates, we are more likely to make money in bonds than lose money in bonds from today going forward. So it makes bonds more attractive than they have been for a while. So if I add all this up, we want to keep our international overweight compared to the US. We are concerned about the valuations. At the same time, if we go all the way back to the beginning, we've had 3 bear markets in the last 5 years. That does not mean that we're due for a fall. It just means that there's some fragility at the top of the U.S. market, particularly the big tech stocks that are pretty uh, high valuations, and they have to keep hitting their earnings estimates just to maintain the price levels that they have. So we want to add a little bit more to bonds, take a little bit away from U.S. stocks, but not wholesale, and then keep the allocation between international and U.S. So I want to move to my last slide here, which is looking at the rest of the year. So as we go to this slide, I want to be very clear. Although I call these predictions, we're not betting that these are happening, but I feel like it's a good discussion so that you understand not necessarily exactly where we're going to be, but the direction on what we kind of see as a base case. So it's very unlikely that all of these will actually happen by the end of the year, but I think it's worth kind of talking through what these could look like. So number one, we do think that there is a decent likelihood that gold approaches 4,000. So it's somewhere around the 3,400 range. Has gone up a lot. It's been one of the best performers over the last 3 years over time. And again, have a lot of clients ask questions. Does that mean we need to sell? Is that a problem? And actually, when we look at commodities as a whole, you tend to have 10 to 20-year cycles instead of your normal 3 to 7 year business cycle that you do with other stocks. Commodities and gold's normally a leader, kind of a front runner for commodity prices as a whole. They tend to move in 10 to 20-year cycles. So a lot looks like, still have plenty of upside for gold over time. So again, this is rest of year predictions. It might not hit that number. It might not even move from where it is. But if I'm going to predict one way or the other, I would expect gold to be higher at the end of the year than it is now rather than lower. Similarly, energy stocks have not yet moved as we're seeing things move through. So typically in a in a commodity super cycle, first mover is something like gold. Then you have silver, which we've started to see happen. Silver, copper, things like that have now gone up in value recently. Oil tends to move next, and so I would expect oil to go up, and with that, energy stocks to go up from there. So most of our clients have a small energy stock exposure through a couple energy ETFs. They have underperformed. It's been one of the worst performers the last 2 years. That's a great time to buy. And so we do expect that if we were to look back second half of the year, I would expect energy stocks to do better than the market as a whole. I'm not saying it's the best, but I would err on the side of outperform instead of underperform. Similar to what's happened so far this year, we would expect international continue to outperform the US in the second half. The international stocks do not have the same valuation concerns. You actually have the opposite, which is most of the skewness is on the upside versus most of the skewness is on the downside for the US. And so that's where I would continue. I would expect that to continue. Again, from a probability perspective, as we look quarter to quarter, we are not trading based on any of these predictions, but we do want to be aware of what to expect. And a big part of this is if something happens differently than we expect, that's information that we need to take into account and say, okay, what was an assumption that was wrong? What was something that's in here? This is a signal that we need to look a little bit deeper. And so, one of those signals is just seasonal performance. As much as people like to talk about investing for the long run and everything else, we are all human, and there is still a consistent kind of technical side to trading on the shorter end, shorter term time periods. And so when you have a year like this year where the first half is up after you've had a positive year before, so we made money in 2024 in stocks, then it was up by the end of the second quarter. Typically, the third quarter is not very attractive, but the fourth quarter makes up for it. That's typically what happens. And so that is our base case, is that we would expect the third quarter for the next couple months to maybe not do as well, but by the end of the year, we're going to end up for the second half. And again, I'll make that bet every year that we're going to end up each quarter, because 75% of the time I'm going to be right. Then if we move down, I do think, and this goes back to our previous slide, I do think U.S. bonds are going to start to generate some positive returns. They've basically been flat for over 5 years. And now I think we're going to start getting some income because interest rates are a little bit higher. And if rates start to fall, you're really going to see some nice performance there. And so, we're going to make sure that we reallocate some excess cash that you might have accumulating that have been earning some good interest. Let's go ahead and buy some bonds while we're at it and use that cash and lock in the yields that we have now. And we think that'll generate some positive returns. And then the last thing I'll say here is IPOs, or initial public offerings. So companies going public. It's been pretty stagnant for the last 2-3 years, and had a lot in 2020, 2021. A lot of clients that we have came to us when IPOs happened in those years. 22 was not a great year for IPOs and really hasn't had a lot so far. We're starting to see some initial view when you see deals that are being talked about and things that could happen. That's a sign of a bull market. You only have IPOs when things are good for the economy, and so that is a good sign if we do see IPOs pick up towards the end of this year, and that's what we would expect as well. So that we see some initial IPOs increase. So with all that, there's not a lot of major changes that we're looking to make in the portfolio, but on the margins, we want to, sell a little bit of the U.S. stocks, make sure we have plenty in international and bonds, and maintain our allocation of gold and energy stocks. And we should end the year in a pretty good spot. As always, reach out if you have any questions. As a note for those who haven't heard, pretty soon here in August, my wife is due with our third child, and I will be taking some time off, but our team is here, whether I'm here or not. They know how to get a hold of me, and we are here to help you and kind of walk through any of the questions that you might have. So with that, I'll let you go, and hope you enjoyed our investment market review and outlook.